Welcome back to Ag Enterprise Management. My name is Matthew Johnson. I'm going to be your lecturer. And if you haven't done so already, make sure you check out the course website. It includes the syllabus. You can also check out La Lima. Lots of information on the class. So today we're going to be talking about business structure and registration. Super exciting stuff. Also very important. This is one of the first questions when you actually go to register your business. You can do it online. It's one of the first questions is what's the business structure that you want to create. So we're going to be going over those different types of business structures. So if you're in a situation where you have to answer that question, you are prepared and you know what to do. So as always, talking about our learning outcomes. We're going to introduce the different legal business structures and the pros and cons for each one when setting up a business. Also go over how to register a business in Hawaii. For learning objectives, we're going to learn the basic business structures including sole proprietorship, partnership, limited liability corporation, cooperative, and nonprofit. And you're also going to learn how to go about registering a business both at the federal and state level. So yeah, these are the typical business structures that you can legally set your business up as. And all of them have different legal and also tax implications associated with them. As always, when setting up a business, you really want to be communicating with a lawyer and an accountant to determine the best type. So please don't just go off of the information from this class. This is a good overview, but to really get down to the nitty-gritty, it's always good to consult a lawyer or accountant. So we have a cooperative, a corporation, limited liability corporation, also known as an LLC, a nonprofit, 501c3, and partnership, and a sole proprietorship. So let's go through each one. Alright, so the first and most simple type of business structure is a sole proprietorship. This is the quickest and easiest business structure to adopt. And if you don't incorporate, if you don't have a partner, you're automatically a sole proprietorship. So if you go and you start doing any kind of business, really legally, you're doing business as yourself under your own name, using your own social security number as a way of kind of tracking the revenues that you're bringing in. And this is a good structure to have when you're just getting started, you're testing out a business, especially maybe if it's just a consulting type business, anything where you're really not having any, really any kind of liability anywhere where you have customers that could become injured or employees that become injured. It's just a very nice, simple way to get started where you don't have to necessarily go out and get a lawyer. As I mentioned, you're just kind of operating under your own name and your own social security number. So with this, you don't necessarily have to register on the federal level, but you do have to still register on the state level, and that's where you can pay what's known as general excise tax, which we'll be talking in more detail about later. Legally, you and your business are the same, so you're really just operating your own structure. The way you're going to be taxed is going to be under your own as just additional income that you yourself have received. Alright, so some of the advantages of sole proprietorship, as we mentioned, it's the least expensive and least complicated business structure to form, and it's good for a trial run while you see how your business evolves. Some disadvantages: owner is personally liable for debts and losses. Alright, so if something were to happen, if you do start having customers, or let's say you're running your farm as a sole proprietorship and someone gets sick, God forbid someone gets sick off of the kale that you grew and sold them, they may come after you and and you really don't have any protection of your own personal assets. So let's say you're sued for $100,000. Your personal assets may have to be sold to cover that expense. Whereas in other kind of business forms that we'll be talking about later, there's a form of separation between yourself and the company. So if the company is sued, it's the company itself, not you as the individual that are being sold. And we're, just kind of continuing on that thought, it offers no other type of liability protection. So it's really you yourself. They're putting yourself out there. So if anything happens, it's on you. Okay, partnership is very much like a sole proprietorship, except there's more than one business owners. Makes sense. So partnership is a single business with 2 or more people share ownership. Each partner contributes to all aspects of the business, including money, property, labor, or skill. In return, each business partner shares in the profits and losses of the business. Because partnerships entail more than one person in the decision-making process, it's important to discuss a wide variety of issues up front and develop a legal partnership agreement. So, as we mentioned, partnerships are just like sole proprietor, but you've got more than one business owner. So, advantages, once again, it's also relatively easy to establish. We can just go directly to the Department of Commerce and Consumer Affairs website and put in our information for the different owners, and we're ready to go. Another advantage is that with more than one owner, you have the ability to raise more funds. Also, it's just better to have more than one person to help with accessing all kinds of resources. So different skill sets, different partnerships. As they say, more than one head is better than one. Two heads are better than one. Something like that. You know what I'm trying to say. Disadvantages. All right, business partners are jointly and individually liable for the actions of the other partners. So when you bring on a partner, just like any other kind of relationship, if your partner does something illegal or is spending all the money, you unfortunately as a partner are responsible for their actions as well. Profits must be shared with others. Right? You have to decide on how you value each other's time and skills. So up front you have to figure out, hey, if we start making money, how is that money going to be distributed? Right? So this is important to figure out and document from the beginning. And then since decisions are shared, of course, disagreements can occur. All right. So one partner may want to go one direction, while the other partner wants to go in a completely different direction. So this just makes it inherently additionally more challenging than a sole proprietorship. All right, next kind of business we have is a limited liability company, LLC. So a limited liability company is a hybrid type of legal structure that provides the limited liability features of a corporation and the tax efficiencies and operational flexibility of a partnership. So this is a relatively new type of tax business structure. It's real popular with mostly smaller businesses. We started Oahu Fresh as an LLC, so it's providing some of the liability protection, but also relatively easy to set up and maintain. So the owners of an LLC are referred to as members. So depending on the state, members can consist of a single individual, one owner, 2 or more individuals, a group of corporations, or other LLCs. So it can get pretty complex where you can have different businesses, organizations as members, as part owners of the LLC. So a lot of different things to consider. So unlike shareholders in a corporation, LLCs are not taxed as a separate business entity. Instead, all profits or losses are passed through the business to each members of the LLC. LLC members report profits and losses on their personal federal tax returns, just like the owners of a partnership would. So basically what this is saying is that the business itself as an LLC is not taxed. It's at the end of the year, you determine if you made money, lost money. If you made money, the amount of money that was made is split amongst the different members. and it passes through onto those individual tax returns, kind of like a sole proprietorship. So it's nice because you don't have to pay taxes twice like you do with a corporation, but the LLC, they call it a pass-through business entity. All right, so the advantages of an LLC, as we just mentioned, pass-through taxation. So under the default tax classification, profits taxed at the member level, not the LLC level. No double taxation. Okay, so the LLC is really just kind of an umbrella almost. So the money comes through to the LLC, but when it comes to tax time, it just funnels through to the members and goes on your own personal tax return. There's also limited liability. So the members, owners of the LLC, are protected from liability for acts and debts of the LLC. So if the LLC ends up owing money, for the most part, the individual members' assets are not going to be held liable. So if the LLC goes belly up and owes $20,000, for the most part, members don't need to worry about their own personal house or vehicles having to be sold to pay off those debts. So disadvantages: earnings of most members of an LLC are generally subject to self-employment tax. Okay, so even though the LLC business itself is not being taxed, the LLC members themselves are going to be taxed at typically a higher rate, which is called a self-employment tax. All right, so this is a higher rate than if you're just paying taxes as like wage income tax. Right, so typically it's going to be around 18% tax. This is going to be a slightly higher rate. So by contrast, earnings of an S corporation after paying a salary to the shareholders working in the LLC can be passed through as distribution of profits and are not subject to self-employment taxes. So, as I mentioned, there's just a lot of these different types of business structures. It all comes down to the amount of liability that you are facing and then how the money that you're making is being taxed. So lots of things to consider. All right, corporation. We've all heard of corporations before. Usually much larger organization. Companies like Facebook and Sunkist. These are all large businesses, and they have a variety of shareholders. So corporation, sometimes referred to as a C Corp, C corporation, is an independent legal entity owned by shareholders. This means that the corporation itself, not the shareholders that own it, is held legally liable for the actions and debts the business incurs. So there's a complete separation between the business and the owners of the business. So if you're a shareholder in a corporation like Coca-Cola, and Coca-Cola poisons, there's a batch of Coca-Cola that poisons and gets a bunch of people sick, you as a shareholder are not going to be held liable for that. The value of your share may go down, but you don't have to worry about losing more money than you initially put in. Corporations are more complex than other business structures because they tend to have costly administrative fees and complex tax and legal requirements. Because of these issues, corporations are generally suggested for established, larger companies with multiple employees. All right, so advantages, you separate the liabilities. All right, so the owners and shareholders cannot be sued or held personally liable for the debts. All right, investors, if you're trying to raise capital by selling shares to the company, you'll need to be incorporated. You also need to form a corporation if you ever plan to go public. So basically this means that if you want to sell shares out to the public, which we hear about with IPO, initial public offerings and whatnot, this is a good way for a company to fundraise and get a lot of money very quickly by selling portions of ownership of the business. Also, another advantage is that it's a never-ending business. So a corporation remains a corporation even if one of the owner leaves, dies, or sells off its stake in the business. So it's called perpetual existence. Whereas in other businesses, sole proprietorship, if it's just you and something happens where you die or you leave, well then the business itself is gonna end as well. Okay. So disadvantages, money. All right, it's not cheap to incorporate. So if you're just starting out and cash flow is an issue, know you'll be paying for such costs as state filing fees, franchise tax, attorney fees, and other government fees. So it takes much more than just going to the online website with Department of Commerce and Consumer Affairs to register your business. You have to be hiring a lawyer, definitely an accountant, to help set things up right from the beginning. There's going to be a lot more paperwork. So as a corporation, you're required to file articles of incorporation, bylaws, corporate minutes, certificates of good standing, other paperwork on a regular basis. So more of your information needs to be publicized. So this takes more work. You need to have systems in place to be able to get these reports completed and filed. We briefly mentioned before double taxation. So since a corporation is its own separate entity, any profits that the corporation makes are going to be taxed at the corporate level. And then any money that the individual owners or shareholders makes are then also going to be taxed as well. So that's why we call that double taxation. There's also going to be more taxes to file. You'll need to file a separate tax form, and you can't claim any personal tax credits on it. Plus, business losses can only be applied to the business. They can't help you on your personal taxes. So once again, this is all about that separation of a corporation being a completely separate legal entity. There's no pass-through. There's none of that. It's very separate. You have your business entity, and then you have your business owners. All right, cooperative. All right, and this is very popular in agriculture. All right, so a cooperative is a business or organization owned by and operated for the benefit of those using its services. So profits and earnings generated by a cooperative are distributed among the members, also known as user owners. Typically, an elected board of directors and officers run the cooperative, while regular members have voting power to control the direction of the cooperative. Members can become part of the cooperative by purchasing shares. The amount of shares they hold does not affect the weight of their vote. All right, so you have the coffee industry has its co-ops. Maui Onions has its co-ops. Here on Oahu, Kokua Market is a co-op as well. So there's all different kinds of co-ops, and could be a really good structure to think about as a way to have more than, it's more of a democratic way of running a business. Cooperatives are common in healthcare, retail, agriculture, art, and restaurant industries. All right, so advantages of a cooperative. Cooperatives have many of the same advantages of investor-owned corporations, such as limited liability for the owners and also perpetual existence of the cooperative. There's no double taxation, and cooperatives are organized on a democratic principle of one member, one vote. Also, control of the business is kept in the hands of those who use the business. So it's really the stakeholders who are involved in running the business. So assuming that they would have much more interest in making sure that the co-op continues and thrives, because they also have, maybe their own business is dependent upon the success of the cooperative. All right, so disadvantages. Cooperatives may not provide incentives for members to contribute additional capital. So sometimes it may be hard, like with Cocoa Market right now. If the co-op itself needs more money, how do you convince its members to contribute more money? And since the benefits from being a member of a cooperative arise through the level of use of the cooperative rather than the level of equity invested, members do not have an incentive to invest in equity capital of the cooperative. So just like any other kind of group democratic system, there's got to be ways to incentivize and figure out, hey, if we need more money for the group, how do we get individuals to contribute? Okay, next group, nonprofit 501c3, which I think a few of you may be wanting to set up your own businesses as. 501c3 refers to the tax code under what nonprofits are registered as. So as an organization that uses surplus revenues to achieve its goals rather than distributing them as profit or dividends. So it's kind of like a misnomer. Nonprofits are able to make money. It's just how they are allowed to use the money that they make, where they are required to reinvest any money that they make back into the mission of the organization. So you don't have owners that are able to withdraw profit. So if a nonprofit gets a grant, board members aren't allowed to just go in and take, however much money they want. That money has to be, is required to go into its own operations. And because of this, they're not required to pay taxes. And there should really be an asterisk by this. It's any money that is generated for the nonprofit mission purposes, not have to pay taxes on. But like if you're a nonprofit farm and you're selling produce at the farmers market, you're still going to be required to pay at least state tax, general excise tax, on any of that revenue that you sell at the market. All right, so advantages. Most of the income of a nonprofit is exempt from income taxes. The contribution from a donor is also tax exempt in most of the cases. So a lot of you have probably done this before. If we go and we donate money to a nonprofit, we get a letter in the mail, and then we're able to use this to write off the amount of income that we had so that our tax liability, our personal tax liability, will be less. A nonprofit organization can receive grants or aid in contrast to business entities that have to use loans as a means of raising funds. So sometimes there are grants available for for-profit organizations, but typically grants and other donors are looking to put money into specifically nonprofits. So that's a big question. Potential donors will ask, like, hey, are you a nonprofit? And if you say no, a lot of times you'll just automatically forego donating any money to your cause, even if it's a social enterprise that you're promoting. Disadvantages. So nonprofit organizations are subject to stricter reporting requirements, because they are not paying taxes. They have to make sure that they are operating the way that they're supposed to by the tax code. Even though grants are great, it can also be tedious and hard to get. It takes a lot of work. There's no such thing as free money. And also, if in case the incorporators or those that created the nonprofit decide to move on to some other pursuits in life, they can't take the assets accumulated by the nonprofit organization. All right, so if you start a nonprofit and you raise a bunch of money and then you decide that you don't want to be involved anymore, you can't just withdraw and take the money and go. It's got to stay with the efforts of the nonprofit. All right, so how to start a business in Hawaii. It's actually very easy, okay? So boom, you've already got your business plan. You're like, yep, this makes a lot of sense. Let's go. You got your business name, and now you understand different kind of business types, so you know what kind of business type you want to do. And then we can go to the, already mentioned before, for Hawaii, we go to the Hawaii Department of Commerce and Consumer Affairs. So you can actually register a business online. You also have to register with the tax guys. All right, so any business structure other than a sole proprietorship, you have to register with the IRS, the Internal Revenue Service, and you need to get what's called a FEIN number, a Federal Employer Identification Number. So this is similar to a Social Security number, but specific to the business. And then we also need to get a State of Hawaii Department of Taxation General Excise Tax License, GET. All right, so here's what the website looks like for Department of Commerce and Consumer Affairs. And it's here, welcome to Hawaii Business Express. All right, so we just start clicking through here, and in about 10 minutes, you can have your business registered, ready to go. Okay, some other things you're going to need: articles of incorporation. Right, so this varies on the type of business, but it's basically rules that govern how your business will operate within the state. as we already mentioned, an FEIN number for any business other than a sole proprietorship. So this is a tax ID number. It means that you are registered to do business. All organizations, either for-profit or non-profit, have tax ID numbers. All right, so when you register with the IRS, this is a letter that you get, and this is something that you need to keep track of. And embedded in here in the upper right-hand corner, you will see the FEIN number. All right, so for this business, number is 27-01-80098. All right, so it's just a legal document, and this is how IRS keeps track of you. So anytime you're doing any tax filings, this is a reference number that you use. All right, so for the state, what we have is a general excise tax. All right, so general excise tax was established in 1930s, and it's actually somewhat unique in that it taxes both goods and services at every level, including food and medical care. So general excise tax is applied to all revenue. So this is irregardless of you making a profit or not. It doesn't matter. It's based on all revenue that you bring in. All right, so GET is currently 4% statewide, except here on Oahu, where there's an additional 0.5% surcharge, which started in the beginning of 2007 to fund this massive rail project that is continuing to go on. All right, so this is a project that we are all paying for. So all goods and services on Oahu, including the city and county of Honolulu, are taxed at 4.5% of gross sales. Okay, so once again, this does not matter what your profit is. It's just all revenue, all money coming in. GET is assessed on the provider of the goods and services, and in turn passes the cost on to a consumer at a rate of 4.712 on Oahu and approximately 4.2% on the neighbor islands. So part of your job as a business owner is to be a tax collector for the state. So anytime you sell a product, you have to pay the state 4.5%. But what you are able to do is pass on that expense to your customers. So you can charge an additional 4.712 to recoup that expense from your customers. So next time you go shopping, look at your receipt and you'll see there should be an additional tax charge of 4.712% on all the products that you bought. This is a picture of the actual general excise tax license. All right, so if you go into restaurants, you'll see this posted a lot of times. So if you're doing business, you are required to be able to show this document at all times. And then you're also required to pay general excise tax throughout the year. So we'll talk more about this when we get into the financial statements and bookkeeping modules. But one thing we have to keep emphasizing. So Hawaii is unique in that you have to pay taxes on all revenue, irregardless of what kind of product it was made for. And you even end up paying tax on the tax that you receive. So if you receive $5 in general excise tax from your customers, you still need to pay 4.5% tax on that $5. Yeah, it's kind of crazy, but something to consider. Okay, as always, go check out the course website for the reading and written assignments. And we'll see you in class next week.